The second factor affecting ROE, I drew a great graph for this, and it's probably an indicator many of you have heard of. It's something that's widely used called DuPont analysis, which breaks down ROE into three factors. You can also estimate how much this company's ROE can actually improve. You can see what's causing the improvement. I think it's a very useful indicator. If you're an investor, it's definitely a good indicator to know. So I'm introducing it while talking about ROE this time. If you look here, this is ROE, net income divided by equity. DuPont analysis breaks it into three parts: net income over sales, sales over assets, and assets over equity. It might seem really difficult, but I drew this diagonal line for you like this. So, just like we learned in math class, if you cancel this out and that out, you're only left with equity and net income. We remember this, right? If you cancel out pairs and everything is gone, they're the same. So it's the same thing. Then what kind of structure does return on equity have to create a company? So I actually think return on equity is the ability that a company's management produces. The first is the margin rate or net profit margin compared to sales, this one indicator. Second, assets are the record of where the company has invested both its own money and others' money, as I mentioned before. The key is how much sales are generated from those investments. From this perspective, this is called asset turnover. So the second point is whether you have the ability to efficiently raise funds, allocate assets well, and connect them to sales. The third point is financial leverage. This means that it's better to make money using other people's money rather than just your own. So this refers to situations where you use that leverage. So since assets are the sum of equity and liabilities, it's about how well you use those liabilities. Since all of these are connected by multiplication, when it comes to leverage, if you want to increase this part, you need to have a lot of liabilities because equity stays the same. If your liabilities increase a lot, your financial leverage goes up. As leverage increases and you multiply all three factors, your return on equity can skyrocket. So, to sum up the return on equity indicator, it's about the company's profit margin and how much you choose companies with high margins. So, that's why Buffett talks about economic moats. That's exactly the area I'll cover later, that part. When talking about economic moats, one of the factors is a low cost ratio, which in other words means a high profit margin. Companies with high profit margins are considered to have significant moats and monopoly power. That's why comparing profit margins is very important. The first is the margin rate, and the second is the concept of growth rate. The ability to allocate assets efficiently and turn them into sales is related to the management's ability to allocate capital. And then the third is how to make the most profit by effectively using debt when you don't have enough money. So these three multipliers, financial strategy, growth strategy, and margin rate, are basically what determine return on equity. So I'll explain it using a real company case. I've brought examples of companies, Nvidia and Sejil. Their ROEs aren't identical but are similar, so I chose them as examples. But they have other differences. So Nvidia has a return on equity of 82.9% and Sejil has 74.2%. So there's about an 8 percentage point difference. But if you look at the numbers broken down into these three categories, Nvidia has a margin rate of 53%, then an asset turnover ratio, which is the ability to generate sales from assets, of 1.16 times, and a financial leverage of 1.35 times. So if you multiply these three together, you get 82.9%. If you look at the company Sejil, it's a little different. The net profit margin is 27.6%, about half of Nvidia's. Even so, the difference in return on equity is only about 8 percentage points, which is amazing. Looking at these three things, the asset turnover rate is similar. In the end, this financial leverage is almost twice as high as the other, which means it increased this. So we can see that this company's return on equity strategy is completely different. Multiplying 1.16 by 1.3, 5 gives 1.56, and 1.14 by 2.36 gives 2.69. The reason I wrote this down for you is because For Nvidia, if the net profit margin increases by 1 percentage point since 1.56 is multiplied here, the leverage means the return on equity goes up by 1.56 percentage points, right? Then for Sejil, if it goes up by 1 percentage point, the return on equity increases by 2.69 percentage points. That's right. So if the profit margin improves by 1% and there's an event that could improve Sejil's net profit margin, the ones with higher numbers here see their return on equity improve faster, and what's important for us is not just the return on equity figure itself, but how quickly it improves. Because I mentioned earlier that the stock prices of these companies will rise much more explosively, these kinds of companies will see their stock prices go up much more. So I wrote these numbers here in small print, but these are the numbers I found on our website using the previous example. That means you can calculate them yourselves as well. So even though these two companies seem to have similar return on equity, when you look at Nvidia, you might wonder, what could Nvidia do to increase its return on equity? If I were the chief executive officer, what would I do? Asset growth rate, can it rise from 1.16 to 2.00? That likely won't be easy. Assets equal the sum of equity and liabilities. When you make money, your profits increase, and when profits increase, equity increases. When equity increases, assets increase. So when sales go up, equity goes up, and as equity goes up, assets increase. This asset turnover ratio is the ratio of sales to assets. So even if you increase sales, assets also increase, which means it's very difficult to raise this ratio. In reality, most companies have an asset turnover ratio between 1 and 1.5 times. Even for Nvidia, no matter how fast they grow, it's practically impossible to double this ratio because the denominator increases even faster. The second way is to increase financial leverage. That means you have to use more debt and reduce equity. Basically, you leave the debt as it is and keep reducing equity by paying dividends or buying back shares. That way you can increase leverage a bit more. Then you can increase the return on equity. And the other question is whether you can raise the profit margin even more than it is now. It's 53%. And the management mentioned it at the conference. They said, next year our net profit margin is 53%, but we expect it to rise to about 58%. That's all they said. Just multiply 58% by 1.16% and 1.35 to estimate return on equity and predict the stock price increase. So there are hints hidden in there. For Sejil, the leverage ratio is now extremely high. While companies sensitive to economic changes often have high leverage, this is unusually high, plus there's the asset turnover ratio. In the end, it seems like if this company wants to improve, it needs to raise this right now. Then you should also check if there are any other companies in the fintech industry like Sejil that are showing this level of profit margin or higher. That's how you determine whether it's reasonable or not, through those kinds of comparisons. So I brought a real life example. This is a Korean stock. The reason I brought a Korean stock is because this chart doesn't exist yet for United States stocks. For United States stocks, we have the return on equity price to book ratio chart, but we don't have this DuPont analysis chart. I wanted to add this DuPont analysis, but I haven't had the time, and about 5 years have already passed. So I couldn't do it, but I brought it anyway. So if you look here, SK Hynix, Hynix is I don't have any stocks yet. I don't have any stocks yet. I didn't have any stocks yet. I don't have any Korean stocks. I don't have any Korean stocks yet. I don't have any Korean stocks yet. I don't have any Korean stocks yet. I don't have any Korean stocks. I don't have any Korean stocks yet. I don't have any Korean stocks. I don't have any stocks yet. I don't have any Korean stocks. I don't have any Korean stocks yet. I don't have any in Korea yet. I don't have any Korean stocks yet. I don't have any Korean stocks. Thank you for watching. What this means is that they're expecting the return on equity to go even higher than it is now. The reason is in the past at this level they gave this much price to book ratio, but now they're giving a much higher price to book ratio than before. The reason they're giving that price to book ratio is because people are betting that the return on equity will be higher than what was recorded in the past. Right now, the return on equity is 38%, 35.8%, but the question is whether it will go even higher in the future. Then, since analysts have their forecasts, you can refer to those, or you can also look at it through calculations. What this DuPont analysis does is, as I mentioned earlier, it's about net profit margin, asset turnover, and financial leverage, these three factors. I've plotted the trends of all three on a graph for you. If you multiply the values of these trends together, you get exactly 35.8. If you look, what is it? If you look here, you'll see that the asset turnover rate has been dropping, then goes up a bit. When the asset turnover rate goes up, it means, as I mentioned earlier, that the company is generating good sales growth with its assets. That's where the sales growth rate comes from. As for financial leverage, the company's average is usually about this much, 1.5 times. It usually stops here, but if not, it's often because the company needs significant debt due to a tough situation. As shown, that's likely the case. With a negative return on equity, the company is likely losing money and has probably taken on significant debt. Leverage has increased but is now at a normal level. The company's return on equity depends on its profit margin, which has dropped. This declining margin shows the company is in decline. Then, if SK Hynix wants to raise this even more, the leverage will hardly change. So they have to change these two things. Okay. Then the question is whether they can increase the sales growth rate even more than now. So the first thing to check is whether the sales growth rate will become steeper than it is now. If this increases from 0.57 to about 1, it nearly doubles, right? Then the return on equity rises to 70%, making it similar to NVIDIA. Then the price to book ratio, which is about 4 times now, could also go up to 8 or 10 times. But what's really important here is the sales growth rate and the profit margin. These factors are crucial in determining how things will turn out. So I'll go to the website and explain how SK Hynix and Samsung Electronics are different, and later I'll show you the same thing for American companies. Or we need to develop the earnings call feature now, plus the chief executive officer assigned homework last week. There's also the artificial intelligence component, and internally we've started a study on how to make this chart better. I think we'll really get started next year, but we'll finish the earnings call feature in December. We'll handle the chart for the analysis part. And for now, let's move to the site and take a final look. Yes? Here we have a Korean stock site that we run called Value Line, but honestly, we haven't really promoted it much. Since it's a data-focused service, we're planning to add Korean stocks directly to Choice Stock, our United States stock platform. So we're planning to let you search for Korean stocks and see trading signals all within Choice Stock. Right now, there are no trading signals here. It's just for data analysis and such, so we told people to use it like this, but some found it a bit difficult. Choice Stock started with United States stocks, but we thought it would be good to make a Korean stock version as well, so we're planning to work on that next year. So first, if I take a look at SK Hynix as an example, SK Hynix has return on equity figures of 41.7 and 42.5 for 2025. That's impressive, isn't it? So maintaining the return on equity means that the earnings per share is growing by that rate, right? In 2025, it jumps from 27,001 in 2024 to 52,001, then 81,001, a huge increase. This is the main reason SK Hynix's stock price has risen so much recently. Then if you look here at the sales figures, 2026 sales are up nearly 35%, showing rapid growth. Compared to the growth in the past, it's very high. So when it comes to asset turnover, there are definitely some areas that could be improved a bit more. But what's more important is how much the margin rate can recover. So for example, if SK Hynix decides to sell more high value added products or higher margin products to Nvidia, news like that could significantly impact the return on equity. In other words, higher margins are good news. So when you see news like that, you can judge which indicators might change and consider giving more value to the company. I guess you could call it that kind of mechanism. Do you have any thoughts like that? Numbers aren't just numbers, and when you hear a certain story, you can also connect it back to the numbers. It's good for us to have both, right? We need to see things through numbers, but we also need to have a narrative, a story. I think we should have both sides together. So I hope you can take a look at those things. If you look here, just like with United States stocks, we have financial charts, exactly the same. And if you look at number 4, there's the ROE BR chart here, and this is called DuPont analysis. So we have this indicator here. So right now, the net profit margin has risen to about 42 or 46%. So, for example, if I look at it by quarter, right now the quarterly net profit margin is 42 or 46%, which is the highest margin compared to the past. It's the highest margin, so the return on equity is also at its highest level, and the price to book ratio is at its highest level as well, which is why the stock price keeps rising like this. Samsung Electronics has recently been showing signs of its stock price rising again. If you look at this financial chart from earlier, it's a bit different from SK Hynix earlier. As for this one, its return on equity in the past was 21% annually. Let's take a look at it over a year. In 2017, it was 19%. This is about the highest return on equity. Samsung Electronics made about 19%. But why is it different from SK Hynix? The reason is if you look below, the highest net profit margin was 18%, and it hasn't been surpassed in the past 10 years. So, it's likely that Samsung Electronics exceeding 18% in the future will be rare. If it surpasses 18%, it becomes a different company. So, the question is, what would the return on equity be if it reaches 18%? Well, it's right above here. If it reaches 18% in 2018, the return on equity was also 18%. So when Samsung Electronics is at its best, the return on equity can go up to 18%. Right now, its return on equity is 8%. It's 8%, and as it improves up to 18%, the stock price is continuing to move upward. But later, this company's net profit margin is much lower than SK Hynix's highest, as I mentioned earlier. If you ask why it's lower, it's because at its core, SK Hynix is actually only in the semiconductor business. So when they make money, if the semiconductor market improves, their profit margin goes up sharply. Since they've invested heavily and have fixed costs, their profit margin improves as products sell. But Samsung Electronics has various divisions, like semiconductors and home appliances. Consider home appliances. Do you think the profit margin is high? It's likely under 5%, possibly in the single digits. So because that lowers the profit margin on their sales, Samsung Electronics is structurally bound to have a lower return on equity than SK Hynix. That's why you can't just simply say, can't Samsung Electronics raise their return on equity to the same level as SK Hynix? If that's the case, the stock price would have to go up 4 times from where it is now. Making that kind of assumption is pretty unreasonable. It's just not realistic. And as for Samsung Electronics, if the company really wants to significantly increase its market capitalization, they could just separate the semiconductor division. At least that's how we look at it in Korea. Then the profit margin would probably be similar to SK Hynix, and the price to book ratio would likely reach a much higher level as well. So if you look at it by separating these three areas, you can see that if the company improves certain indicators, things could get better. Earlier, I did a quick calculation, and right now, if Samsung Electronics wants to reach a return on equity of about 20% or 18%, the ranking here, it's a bit small, but the column labeled ranking here, it needs to go from 32 trillion won to about 60 trillion or even up to 65 trillion to reach that amount. If you look at the quarterly data in September recently, they earned about 12 trillion won, which is a significant increase compared to before. Things are moving in this direction, and there has been a lot of positive news about Samsung Electronics recently. So, yes, that's why Micron has recently been focusing on the data center sector. And as they move away from things like dynamic random access memory, this will be a very good sign for Samsung Electronics. Since it has recovered to 12 trillion, earning that each quarter would total 48-50 trillion a year. Then, if we assume it goes up to around 60 trillion, as we mentioned earlier, the return on equity can recover to its highest level. So, it seems possible to recover to that extent. It's not unreasonable. Then, if this company's return on equity goes to about 18% to 20%, we're looking at what kind of price to book ratio multiple it used to get in the past. So, if I calculate the price to book ratio multiple this company used to get, not just what I calculated earlier, but if you look here, let me take a look. Sorry. When return on equity peaked at 20%, price to book ratio was about 1.6 times. If Samsung Electronics rises to 20%, it could go even higher. So based on the data we've seen so far, if things keep getting better, we have to keep adjusting as we go. Then it could go up to about 16 times. So you calculate what the stock price would be at 16 times, right? How much would the peak be? So if you calculate that, the current price to book ratio is 1.6 times, but now it's 1.9 times. And looking at it now, it's 1.5 times. It's almost all the way up now, isn't it? That's right. So what this means is that the market already knows that its return on equity will go up to about 20%. It's already reflected. So even though the recovery wasn't that fast, I wondered why the stock price jumped from 50,000 won to over 100,000 won, but actually the market already knew. That's what it was. It moved slowly, but that's how it was. So is this the peak? That's the question. This thing called price to book ratio is the market capitalization compared to total equity. If you look at the bottom here, let me make the text a bit bigger for you. At the bottom, you can see the total equity. The total equity is increasing like this from 402 to 413, and now it's gone up to 3,640. It's increasing like this. That's why, if that price to book ratio can't go any higher, at the very least, the stock price will rise as much as the equity increases. The stock price needs to go up as much as the equity does to maintain that price to book ratio. So, what indicator shows the increase in equity? That's a return on equity. Return on equity is the rate at which equity increases. Yeah, if this company's return on equity is expected to be 18-20% in the future, buying at this price could mean the stock might rise by about 18-20% in the next year. With the current stock price at 108,001, multiplying by that rate gives about 130,001, which could be the initial target price. During that time, as some semiconductor companies shift due to data and artificial intelligence, this company's return on equity could rise from 20% to about 23-25%. So it means it won't stop there. But if at that point it's not that the profit isn't coming in, but the return on equity stops at 52, that means the growth rate is starting to decline. So if it starts to stall at that point, that's probably when the stock price will enter a bit of a tough period. Right now, of course, things are going well like this. Yes. May I show you just one last chart? I think it would be good to show you this. This is a chart of Samsung Electronics, and if you look at this chart, it starts from 2025. Then you can immediately see when you should invest. If you look at the stock price, it accumulates the most at this time, then here, here, and here. So if we look at it over 10 years, obviously, we should buy at these points. Also, the stock price has never fallen below this blue line.
It's the first time in a decade.
This is something that's never happened before. So this was an incredible opportunity. But people say, oh, isn't Samsung Electronics going to fail? Only SKX is doing well. Samsung is finished now. At the same time, there are a lot of articles, books, and a ton of criticism coming out. But cyclical companies come back to life again. And as they recover and go up like this, when they rise even more, a different logic starts to appear. Now people say, this isn't the old Samsung Jonja anymore, right? But I'm sorry, even back then, people said it wasn't the old Samsung Jonja. And at that time, too, they said it wasn't the old Samsung Jonja. But what I wanted to show you with this time series chart is that this history keeps repeating itself. But if the time comes when this blue chart and this green chart meet again, there will probably be a lot of negative news, but that's actually the best time to buy. And if I show you SK Hynix as well. Yes, if I show you SK Hynix, if you look at SK Hynix, it ended up like this. It broke through like this, and now it's become really expensive. It's rising due to expectations of higher growth. So, people say that these indicators or financial statements are just records of the past, and that's true. But we look at the past to help us predict the future. We check the rearview mirror not only to watch the car behind, but to ensure we move forward safely. It's the same concept. Okay, so don't ignore financial statements just because they're from the past. Look at the past to see what kind of patterns the company shows, and then use consensus data to look at the future. By looking at both the past and the future, I believe you'll be able to invest in a much healthier and more comfortable way than just focusing on the present. That's all for today's lecture.
Today was a passionate lecture, and I think many of you were very satisfied with it. Last week, I think the key point was that it's not just about having a high return on equity, but about how long you can maintain that high return on equity. We learned that the longer the period you can sustain a high return on equity, the longer the stock price can keep rising. In today's case, rather than focusing on the period, it's more about how much volatility there is. There are companies that consistently maintain a high level, and then there are stocks we call cyclical stocks, which go up and down. In both situations, companies that consistently maintain a high level are experiencing structural growth, so their stock prices can rise even more. And another thing that left an impression on me was that earlier, when comparing NVIDIA and Sejil, actually, Sejil has a much lower return on equity compared to NVIDIA. But the reason why Sejil's stock price can rise much more when its net profit margin increases by 1% is because its return on equity can increase much more. But I think you can look at it this way. In the end, having a high return on equity is very important, but I think it's even more important for the margin to increase by a few percent. So it's basically saying the same thing. Sejil can rise more with a 1% margin increase because unlike Nvidia, where margins are already high and a 1% boost matters little, for Sejil, that same 1% has a much bigger impact. So what's important is the rate of increase in the margin, not just which company has a better absolute value. I don't think the absolute value alone means that much. So what I hope you'll remember today is how much the growth rate is accelerating. And when the margin increases by 1%, which company does that 1% mean more for? I hope you'll focus on this point when choosing stocks.
May I say just one more thing? What came to mind as you were speaking, sir, is that earlier the net profit margin, the asset turnover ratio, sales growth rate, and financial leverage, when you look at these two factors at the end, the companies that stand out are large-scale ones like Chosun Chemical Heavy Industries. So even if the margin changes from 1 to 3 to 1 to 5 times due to economic fluctuations in the front, because the scale at the back is so huge, the improvement speed is incredibly fast. That's why when the market shifts, a stock can rise 5 or 10 times, but also drop around 80%. This applies to companies like Chosun Heavy Industries, chemical firms, and even some automakers. Those companies are very large in scale, so if the market margin improves even a little, the leverage at the back end becomes enormous in two ways. That's why industries that are sensitive to economic fluctuations can present great investment opportunities, but you also need to be extremely cautious when investing in them. I just wanted to add this point.
That's why I think Korean people like volatile stocks, because those triple leverage companies all have this kind of high volatility. That's correct. After today's lecture, I've become interested in a few stocks, Micron and SK. It'll be interesting to see whether Samsung shows its cyclical pattern again this time, or if it keeps its current momentum.
The key is whether it surpasses its highest past return on equity or not. That should be the perfect indicator.
All right, great. For those who attended today's lecture, keep an eye on how the return on equity changes going forward. And if you're investing in these three stocks, it might be a good idea to adjust your strategy accordingly. Thank you to the Chief Executive Officer for another clear and excellent lecture today. So does that mean we're wrapping up return on equity today?
Yes, return on equity is finished. Next week, companies create a moat, a monopoly power structure that lets them keep earning money this way. We usually look at certain indicators to assess the quality of a business, but are there any indicators that can help us quantify or measure that quality with numbers? Over the next week or two, I'll introduce and share those with you.
That's right, confirming an economic moat with numbers.
Yes, that's right.
So, yes, that's also where our synergy really shines, which is great. I've emphasized economic moats countless times on broadcasts. But figuring out how to express this, not just in words or stories, but numerically, is actually quite a difficult problem. I'm personally really looking forward to the lecture on this topic.
Yes, I'll make sure to prepare well.
Yes, thank you. You worked hard today as well. I'll do my best next week, just like today's great lecture. Thank you for watching. Yes, thank you. Thank you.
The start of a small dream is important. Let's plant a hopeful future together, growing little by little every day. Is there excitement blooming in your heart? Let go of greed. I won't lose this time either. The result is just a continuation of the process. Even if darkness comes, I'm not afraid. I'll hold your cautious hand and become the light for the unseen tomorrow. Happy investing, supporting each other's dreams, and walking together down a beautiful downhill path. Happy investing. Together with Miju, we will all be happy until the day we boldly retire with national stocks.